Here's something that we've also kind of noticed. Because of the exchange rate devaluation that's happened in the last 2 years and the fact that we have like a free market now where, well, something close to a free market, a lot of importers are struggling now to compete with local manufacturers that have very good substitutes. Because before now, what was happening is that you just have people go outside the country, import all sorts of stuff, and start to compete with the local market. So, but the local market now can compete better because everybody's basically on an even playing field. And so it's easier to compete with these guys. And so that's why we're seeing the likes of Nestle, Cadbury, Boa Foods doing pretty well now because market penetration is a lot better for their products. And they seem to be able to price their products very well, and that is helping boost margins. So no surprises here that in the first quarter, the company reported a pre-tax profit of 51.1 billion naira. Now, this is a huge reversal from a pre-tax loss of 196 billion naira the same period last year. Imagine in one quarter, did a 196 billion naira loss. So now Nestle is back to profitability with 51 billion naira. And this, again, was largely due to a reduction in its finance expenses because the year before, Nestle was taking in huge losses due to exchange rate devaluation. But now that that is basically out of the way, it looks like their balance sheet is getting a lot better. So Nestle up 44.6%, but that stock is pricey, like super pricey. I was looking at this price to earnings ratio and something tells me maybe there's an error somewhere, but it's looking like it's over 100 times his earnings. Of course, I guess if you do, because earnings usually, price to earnings ratio is usually the market price of the stock divided by its trailing 12 months earnings. So if you look at the Q2 2024 to Q1 2025, you probably would have a very minute earnings per share. But investors don't really care because investors are looking at what is coming for Nestle. They think that Nestle is going to have a very good year. And so they're already pricing that into the share price of the stock. And I think there's also feelers that Nestle might need to raise capital at some point. And so that is also perhaps driving the share price higher than it currently is. I don't think Nestle is one of those stocks that you want to get into at the moment. I really doubt it because it's very expensive. So if you did not buy Nestle when we recommended it or when we talked about it earlier in the year, this one seems to have just like flown past you. All right, so we go to the next stock that is one of the hottest stocks in Nigeria at the moment, and that's Champions Breweries.